Hi, my name is Felix Fry.
And I'm Marko Rajnica.
We're here to find great trading opportunities that target 150 to 400% returns. And you? Well, you're going to help us do it every single day. So welcome. This is the Winning Picks Podcast. This podcast is for educational purposes only. OptionsGeek LLC is not a broker-dealer. OptionsGeek LLC, Felix Fry, and Marko Rajnica are not registered investment advisors. Keep in mind, options involve substantial risk and are not suitable for everyone. Please consult your own investment advisor before doing any trading. Make sure you read the full disclaimer at the end of this episode.
Hey, Felix.
Marko, how you doing, buddy?
Great. How are you?
Good. I wanted to start with a few things. Actually, let's just jump in real quick to learn something, because I think every trade, whether you do the trade or not, every situation, you're going to learn a lot, right? You're going to learn different things, different nuances are going to pop up, and hopefully you won't forget this one.
Okay.
While it may have, you may not have. I'm not sure if you play Tesla, but it's something for you to remember now, and for you to always have in the back of your mind. Okay, so let's look at that. You have my screen?
Yes, I do.
Perfect. So in Tesla, obviously there was the ad on Friday, and forget about where it is right now. I really want to focus on sort of how it transpired right at the very end. And one thing that I was mentioning over the week and a half prior was that the best thing that could happen for the investment banks is to get the little guy out of the way, right? Get the little guy out of the way, and then they can push it wherever they want. If they don't get the little guy out of the way, the average investor, the retail investor holding the 1 and 2 lots, and then there's 100,000 of them, then that little guy is going to sell it to the bank, and the bank, as the bank is trying to push it up, the little guy's not there. What transpired is interesting. We spoke also about the different points in time of when the sale would happen and when buy would happen. That mismatch, just because there's 50 million to buy and 50 million to sell, that doesn't mean it's going to match up very easily and simply at the right price. What happens is some people sell first and then some people buy after, or some people buy first too early. Then there's this, we don't know. However, what I want you to see here very clearly is that the market traded up, down, and was finding its level, and looked like it wanted to go to wherever it was going to end up, right? It looked like it wanted to go to close to 700, right? That's how it was sort of moving. And then all of a sudden, right here, it started trading lower, dropped quickly, rebounded a little bit. People, still buying this, this thing's going to close up, and then just got trashed, maybe a spike here quickly, and then trashed all the way down to 627.5. And this is with 15 minutes to go, right? It even was trading at 630 with about 10 minutes to go, and then it just took off. And eventually they printed it at 695. So it's not even on the map here. They were allowed to print it at 695, and that's where the final trade happened.
And look at the volume, like wow.
Right. And so the funds, the S&P funds got Tesla at 695. The banks were able to sell at 600. Who made a lot of money? Clearly, the banks in this trade made. I gotta suspect that there was several $1 billion made in this trade, as people as they were able to buy it from the announcement at around 440, even though they probably weren't buying so much then. But a 440 up to 460, 500, 550, they were involved all the way up, and then they saved enough bullets to actually push it all the way up. Remember, it went from 627 to 697. Now, that's the story. That's what people saw. What people don't realize is that these online brokerages, okay, so call it Robinhood, E-Trade, TD Ameritrade, Schwab, Fidelity, sorry, at right around 240. Right around 2 o'clock, 2:40 Eastern Standard Time, okay? Risk management at all of these online brokerages, they don't take risk. They don't want risk, okay? They really don't like risk, right? Because risk could hurt them, can take down their business. So on every expiration, okay, every expiration, if you don't have the amount of money to actually exercise your options and take down the position. So in this case, if you own the 650 Tesla calls and you own $5 4 weeks ago, and now they're worth 30, and you think they're going to be worth, 60 in about an hour and a half, hour and 20 minutes, Schwab, TD Ameritrade, E-Trade, Fidelity, they don't care. They simply are looking at your account and they're saying, you own 5 of these, that's 500 shares of Tesla, and you at 4 o'clock in 1 hour and 20 minutes, you're going to have to exercise, and do you have the money to take down 500 times 650, which is about $325,000. So do you have $325,000 in your account to exercise these options if you have to exercise? And if you don't, then you've signed a contract with all of these firms that they can actually blow you out of the positions. And so a lot of people don't realize that. And guess when that starts? Take a guess.
Right there.
At 240 is when many of these starts. 240, 245. That's when all of these guys, they look at their book, the millions of investors that are out there, and they say, do they have the money? No, sell it. Do they have the money? No, sell it. Now it goes for puts and calls. Okay, but usually out of the money puts, they don't really do it. They're usually looking for like in the money stuff that might be exercised. And they have their rules and they have, what they're looking at first. But again, if you don't have the money, they sell it. They sell it. They sell it. Well, as you can imagine, this is all being sold. So, sold. Probably if you're long puts here, all of a sudden that's sort of like, helping the bid a little bit, because they're probably selling you out there. And then with 10 minutes to go, the retail investor has just been sold out right here. This is the retail investor right here. That's the retail investor right there selling. Okay. Now, if you're a big investment bank, you might not, maybe this. And matter of fact, who owns E-Trade? Morgan Stanley, right? So, this, what's going on. And so the bid could be lighter here. And then once the all clear sign comes where you know that it's going to take an hour. So this is 240 to 340. Maybe they know, maybe it's just a rule that, we basically clear everybody out in 1 hour, 240 to 340. If you don't have the money in Tesla to exercise, then we're going to take you out of that position. So they know 340, okay, 340 is the mark. They start buying here and then they can push it. And the reason they were able to push it so high from 625 to 675 was because this buyer from 240 to 340 was gone. The millions of shares that were being sold here were gone. All this being sold. These are a million, all the way up to several million, 3 million here. So all of this, millions of shares were being sold, not shares necessarily, but they were being sold through calls. So when someone's selling calls, someone else, the buyer of those calls needs to sell shares. Okay, so in this case, usually the buyer for the retail investor is going to be a Citadel or a Virtu, and they are buying these options and whacking stock, just selling the bid, hitting the bid all the way down. And I assure you that you're probably not getting the best bid on your calls because it is selling them and it's just selling market sale. They're not trying to trade your account. They're trying to just get out of the risk for them. Okay. So have this big downdraft and then go. So what's the lesson learned? The lesson learned is that there are forces out there that you may not be aware of, such as risk management, that clears out the retail investor on the last day of expiration and then takes it and then takes it out. So in the event that there's another ad or big ad, not like this, there probably won't be like one like this for a while, but if there's an event that is happening on a Friday, understand that the market will take out, and it's happening at 4 o'clock on a Friday, for whatever reason, whatever the event is, the market, many retail participants may not be able to actually reach that event. And it goes for anybody trading, anyone. If you're looking for an event on Friday afternoon and you don't have the money to actually exercise your positions, the firm might actually just sell your position out before the event even happens.
Wow.
Okay, so it's something to think about and something that I would suspect many millions of people learned that lesson on Friday.
Hard way, right?
Right, because they probably were like, wait a second, I don't have any Tesla calls anymore. They look at their account, they're like, my Tesla calls are gone. What's happening? It's because the risk management at these firms are selling you out.
Huh. Can they do that? I mean, obviously they can't, but
They own you're in their house. You're playing the game within their house. You're playing by their rules and their risk managers. Now they're not doing it one by one. They're actually it's computerized and now some of it is maybe they have I don't know exactly. I've never been behind the scenes to know this, but I do know that 240, 245 is sort of that level. Sometimes it's 240 to 3 o'clock, and they start looking. In something like Tesla, this is such a big deal that they wanted to make sure that they have no risk. Because as you see, the stock could be up 70, down 70. What if somebody's holding naked calls, short naked calls at even call spreads, the 675, 200 call spread, 200 calls, 675, 700 call spreads. If they're short that and the stock goes all the way down here, they know, these risk managers, they know that the stock could go out. They'll just blow you out there too. They're just going to take you out. You're not going to have a position here by the end of the day. In general, sometimes they miss it. Sometimes, they have so many accounts, but in general, that's what's actually happening.
I see.
Interesting, no?
Very interesting, actually.
So you can't, there's always something to learn. In this case, you learn that there's this risk management that can take people out of positions, including you one day, if there is a situation where you can't actually exercise the amount of options that you're doing right on expiration. So keep that in mind. Now, let's get to today. Let's figure out what's going on today.
Cool. I had a question regarding the UAE board and the whole SPY situation and things like that. So I was looking at it, and I've seen like a lot of reds. A lot of stocks have been going down, and there's been a lot more put buying, let's call it. So I was kind of thinking, okay, like the usual stock trader psychology goes with, we're buying stocks and we're hoping they go up. And I mean, that's pretty much similar with what we're doing with direction and calls. But when it comes to puts, myself, I'm very optimistic usually, and I like stuff going up. And like just the thought of, okay, how can I analyze this put trade kind of puts me off. And I want to, I want to get your perspective on it, how you think about it, how would you think about it?
So we have this put. We bought that put on Friday. We have a 2.5 week January 6th put on, and it's there for a reason. It's there because we have calls on. We have a decent amount of calls, and the calls are. There's logic to sort of what's happening here. There's the calls to some extent are 3-4 months calls. We have some commodity calls. Some of these options should hold up okay. We've been long Walmart for a while. Probably for some people, Walmart, depending on the entry, could have been, had an exit, one exit. At 100%. It's marked at 90%, but just depending on where you got Walmart, and you could have gotten it lower, maybe you had a chance to get that one exit. Walmart should probably hold up in an event that the SPY's down significantly, because it's a thick name, and if the SPY's down because of coronavirus, it would hold. So the logic behind buying puts in a portfolio filled with calls is and matching the expirations is something that I'm watching, and I'm trying to do that for the average investor, for OptionsGeek members. If we have say 5 trades in calls, say you have 5 trades in calls on, and you look and there's no puts, right? But I look at the board and I say, can the market go down? Of course the market go down. The chances of it going down, I don't know. I'm going to lay some odds on it, but the reality is, if the market's down 5-10% for whatever reason, you just wake up and it's down 5-10%, it's not going to feel good for, the call, a portfolio filled with all calls. And so it's prudent and it's good risk management to just have something that will offset some of the, perhaps steep declines in calls. Right. Now, how do you think about it? Well, the 2-week option has a lot of leverage. So I don't need a 3-month SPY put, because a 3-month SPY put is going to behave very differently than a 2-week SPY put. So do I like buying it at the time when, I say, all right, I'm going to buy it right here? That's a different argument. But I do see that there's risk here, and I do see that there's potential for waking up and the market's down 5%. And I want to make sure that we're not all long calls. And even though some should hold up fairly well, we're not just long calls. Like, we want to be able to make a little money back on the way down. You should always want that. right? I tell you, even if you looking at your portfolio, you know where your exit. And the SPY today could have had one exit. It depends again where you got in. I marked it at 340. It got to 650. Okay, I'm not. It's not a on the board. It's not going to say 100%. But if you got 3.25 and the thing traded 275 at the end of the day, so if you waited a little bit, you're a little bit patient, you got it a little bit better than I had posted it, then you could have gotten that exit. Your average price is say $3, 3.25. You're exiting one. You should take that exit. It shouldn't be that you start thinking that that the SPY is going down. I'm trying to. What happens is that the emotions are up, especially if you were up early today. If you're up early, you realize that the market was actually down, was trading 658 to 358 this morning, probably 4:30 or so. And Germany was down big. The UK was down. The dollar was up 1%. These are big macro moves, big situations. And the US market was down almost 2.5%. So things were looking really ugly. And then when people woke up, it was like, the market's down 1.5%. That's not how it looked at 4 o'clock in the morning, 4:30 in the morning. And so these, the psychology of the market is incredibly important to understand and incredibly important to start to be able to look at. Let me show you a little bit of why of what could happen. So let me, I could share my screen here again. You tell me when, let's see here. You see my screen?
Yep. Go ahead.
Okay. So first of all, the VIX is up today. Okay. It's up because the markets, got hit a little bit and now it's trading back up. So you see the VIX traded 19.5 and now it's back to 1840. But if you look at the, let's look at the SPY daily, you see this sort of move here and it's trying to find its way back in this channel, right? It's trying to find its way back. And if it does, and it starts retaking 70, then all this was a shakeout. It scared the longs that were just kind of playing around. And then and this is what it does. It's either going to shake the tree and go that way, or this could be the start of something perhaps a lot bigger. Why would I say that? Well, it's usually the reason I showed you the VIX was because usually you don't get the VIX at such a low level here. Okay, the VIX was at such a low level over the last couple of weeks. Usually what happens is you get a spike in VIX first. The market does its dance up and down. You get a spike in the VIX. Maybe tomorrow, if the market's down a little bit, you'll get a move to 20, right? What that does is that actually causes the board to inflate, meaning the prices, they inflate, they're higher. Psychologically, it becomes, much more difficult to buy way downside puts when you see the market climb back the way it did. So every time the market climbs back and people are buying the dips and it works, it becomes very difficult to even fathom that the stock market could actually get to like 340. But, these are big gaps here. You see these gaps here in the SPY? Gap. That means not much traded here. Yeah, there was some traded, but there's a lot of room here to potentially, if this is like a vortex, right? If it gets through 350, this becomes a very dangerous, very, very dangerous area. Not much was traded. It was like it got the shorts out and then it immediately jumped. So the longs couldn't get in that much. So the longs are getting in right around here on average. So when you get here, the test could be 350. Right around the 350 range. Does it get there? Again, no idea. But I can tell you that last night it was trading around 358. And if we wake up and it's 358 or 355 tomorrow, I can tell you that the market is going to make people feel a lot of pain. I don't know if that happens from 367 to 355 or it goes to 385 first and then drops to 365. But the market has a funny way of, it's like a tsunami. It makes everything calm, the water's calm, and it recedes, and you're allowed to be 100 feet in the water in the ocean because the waves aren't as high, and it's awesome, and you're playing around, and then all of a sudden there's a 100-foot tsunami coming, and you can't get out of the way. Right. So the market has a funny way of doing that. So I look at these areas right here, and I say, a lot of gaps. There's some volume, but this is a problem area. Okay, the market is floating higher. Okay, it's got, it's average volume, and then you have this sort of large move from on Friday afternoon very quickly on a compromise, potential compromise. You get the compromise, and then it trades down 2.5% overnight. Again, this is what the market does. It made everyone sell. The reason there was no one that was long puts. Let's just look at the puts now, so we can go. Which one do I have here? Let's see if I have one. So let's look at the puts, and you can just see for yourself that you wake up and there's no one long. There's no one long. Look at the open interest. There's really no one long from 370, 369, 368. Nobody's long there for the one-day options. Now, if you look, the options are loaded up. They've come back to them, right? They immediately came in and bought options all the way from 364, 362, 34. Now there's 70,000 here. In order for the market to turn around today and sort of crash, these people have to bail out, because the market's not going to pay you, or doesn't, not that it won't, it doesn't want to pay you on a 20-cent option. So if you buy this 20-cent option, the market's not going to reward you and make that worth $2, $3, unless there's some shocking news and maybe it goes down. Same thing here, 35 cents, 63 cents. The market is trying to, the way I like to say it, hurt the most people at any one time. Right, it's water. It goes to the least resistance. So go ahead.
My question here is: Are these mostly day traders, or?
Sure. So what I've seen over the last 6 months, and it's getting more and more pronounced, the volumes that you see. So we'll look at, this is going to expire today. So December 23rd options, you'll see they're less. Right, the 360s have 40,000, but that was probably in the morning, and then by now a lot of them have probably sold out. Right, and you can look at that by looking this chain. You can see in the morning volatility is up. Okay, volatility is up. There's buyers holding volatility up, and then all of a sudden the market takes off, and then the volatility gets crushed. And as it's getting crushed and the market's going up, what do you think all these volumes are doing? What do you think they're doing? Right. They're likely selling everything they bought today. They're the day traders, 5,000. So you can watch the market and say, okay, the market's coming off here. They're buying puts. The minute the market catches a bid, vols start coming off. People start saying, we might be bouncing here. They start selling, and they're still selling. They're still selling. Now, once they get out of these puts, what happens? There's no more puts left. So the market might be able to come back down at the end of the day, late in the end of the day. But it's one of these things where it does this dance, quickly. And Friday's move up was very quick. And then Monday morning's move down was very quick. You see how that happened? It was like who's going to be long these puts except us, on Friday, when the thing goes from 77 or 76, it's fighting there all day. And then in 10 minutes, it goes right to like 67, it goes right to 271, 371. And then 371, it looks like the compromise. It looks like it's going to trade 375. And then this morning at 4 o'clock, it's trading 358. It's because again, it's making it impossible for you to hold puts. So, how many people, does everybody own puts when the market crashes? Well, that's not the definition of a crash. When the market crashes down, the definition of a crash is that no one owns puts, that they became too expensive. So this movement of the VIX or the VXX, whoever have you, as implied volatilities go up, and they are going up today. So the market's kind of come back to where it was on Friday, yet the volatility is now higher, which does what? It makes it more difficult for you to pull the trigger to buy puts. Okay. And if it keeps doing this for the next few days, what's going to happen? No one is going to be there to buy puts. No one is going to want to spend $4 to buy a $6 out of the money put. They're just not going to want to do that. But when you start thinking about that, and when you start seeing that the market's in a dangerous spot and the volatility is very high, which makes the prices higher, which makes, when they're $1, you can buy 100 of them for 10 grand. When they're $3, you can only buy 330, right?
Right.
I'm sorry, 33. Sorry about that. So you can only buy one third of the amount that you could buy at one. So that's what the market does. It's this mechanism where it starts saying there's danger. It raises up the VIX. You can't buy as many options as you did. You know, people always say, man, I had 3 weeks ago, I had 100 options, 100 puts in the SPY, and it didn't pay out. When it crashes, they're like, I can only buy 2. I can only buy 20 or 30 or much less than what they had when the market was going up, because it doesn't allow people to buy so many puts. If you have so many puts, it's leveraged to the downside, and the market can't go down when everybody's levered to make money on the downside.
I see.
Okay, so this is the game that's being played. When I look at it, I tend to look at the open interest and see where the positions are. And, you know, December 28th, you know, you could just see for yourself. There's nothing. There's no players here. No one is going to make money on the market moving down right here on December 28th. Now, today, again, we showed that they're there. You know, they come, the day traders there. They'll be out by tomorrow. You know, same with the 2-day options, the 23rd, the Wednesday. You'll see them playing around here. Watch how that open interest train changes tomorrow. 23,000 on the 63s, maybe 15% of that. That might only be 3,000 to 4,000 options stick around.
So does that mean if they buy and sell in the same day, the open interest doesn't count it in?
Usually it's not going to. It can, but usually it's not going to. And the reason why is because you have one big player who's the other side of everybody's trade. So you have Citadel, who brings up another good point, but you have Citadel, who is the other side of your trade. And if you're trading at E-Trade or TD Ameritrade or Schwab, when you buy, they sell. When you sell, they buy 60% of the time. Citadel owns 60% of the market. So it's highly likely that Citadel is just, you bought it and then you sold it to close. Citadel sold it and then bought it to close. They did the opposite. Okay. So what you'll see is, you'll see again, you know, if this works, you know, how it might look, you know, you have this puts over here. It looks like people were selling these 363 puts, right over here. They started selling them because the vol started, buying them because the vol started going up. Then as the market moved, they're selling them over here. It's even getting more pronounced. They're just, you see the vol's not going up. It's just for sale. So people are selling these December 23rd, 363 puts. But look how much they're selling. You can count it. 5,000, that's 8,000. So you could see that they're selling. And when they're selling, remember, they're selling pieces of paper, but to them, it's just a piece of paper. To the buyer, Citadel, that piece of paper means what? They're going to buy the puts, and they actually have to go buy stock, buy the SPY. And so by you selling puts, you are putting pressure upward on the stock, on the SPY. So what you're seeing here is people selling out puts. They're also putting pressure on the SPY going higher. Okay. Now, once they're done, remember, it's a mechanism, like we just said. By the end of the day today, and open interest tomorrow, 23. You watch 23,000 is the volume. Tomorrow, maybe it's 5,000. Maybe because this is a 2-day option that people stay on for a little bit longer. So I've seen 20 to even 25, 30%. So even if it's 25, 30, it's 6,000 options. So tomorrow that's going to read maybe 10,000 plus 5 to 10,000 plus 5 to 6,000. If that's the case, it's still not a lot, you know, for Wednesday. What do you have? You know, at this point, you'll have 7, 3. This is nothing. Huge open interest is 100,000, 250,000, 300,000. That's significant open interest. That is a brick wall. This is like nothing. If the market wants to go down, it's going to eat right through this so fast. So something to think about, and something that, you know, for yourself, when you feel like you might be too long, it's good to understand open interest and understand, you know, to find where the bet's being made, where are things being made. January 6th, no open interest, zero open interest. Okay, nothing. There's open interest here in the 340s. There's nothing. I mean, there's just no open. Nobody cares there. How about January 15th? A little bit. It's going to be a little bit more because it is the regular month. So if you're looking here, 370s, you do have some 27,000, 15,000, 31,000. You're already at 65. You have 31,000 there. The 60s, you have 50,000. But remember, you have 50,000 here. Okay, those options cost $5. So in order for the person to make money in a risk reward basis, he's got to be thinking, look at the level, 346. Right. He's thinking the only reason he'd be buying those is to protect against what? Exactly what I just showed you. They're protecting against not 345. He thinks this thing could be right back to 325 if it goes down. Okay, so that's what, you could just look at the board and start figuring out, where does the market think it's going? What are people buying? Where do they think it's going? So in this case, if they're buying 50, if there's 50,000 in open interest and they've paid anywhere from $5 to $8, think about how far they think it's got to go down. That's the only reason they're buying it. Make sense?
Yeah.
So that's how you can look at this RR dollar and sort of say, where is the risk? Well, the market is not stupid. The market is saying, for January, it's only 3 weeks away. We're going to price in somewhere around here. And, what happens if it gets there? If it gets there, then you have a situation where we're in here, we're through the 50-day, and, who knows what happens? Something bad, likely with coronavirus, has transpired, and that news is building every day. You're starting to hear more and more people that don't want to take the vaccine. The media is trying to push everybody to take the vaccine. Who knows how that plays out, and who knows how the news cycle works here. So again, I don't know where this thing goes, but I do know that the risk reward here is it's in a dangerous spot. And when I look at this, you look at sort of this recoup that's obviously pretty bullish. We'll see if it can hold there by the end of the day, but it's recouped that sort of this tight two parallel lines, this tight trend range here. So that's something to watch. If it closes below that, then it would be below this trend line here, and maybe that's what gets it down. But if it goes back up, this is a dance it's doing. This could either be that it's going to break this and move lower, or it's going to make this move because it just got everybody out, or a lot of people out that were unsure whether they wanted to be in, and it's going to move higher. So that's my 2 cents. Don't treat any one option. Don't treat, just because it's a SPY, don't treat it like anything different. If you hit 100%, then you want to take a little bit off the table, because nobody knows what's going to happen. And you get 100%, and then tomorrow it's down another 5%. Okay, then that on 100% you took some money off the table. On the next 2/3, you're going to actually make a significant amount of money. And that's the way the game is played, and that's how you have to keep playing the game and try to be as methodical as you can. So in a situation like today, I do get emails. Now, what do you think? Now what's going to happen?
Right.
I'm not a wizard. I have no idea. I just simply know when I see good risk reward that, this offers us good risk reward, and it's only one position in a larger portfolio. And of course, I don't want the market to crash. We're long stocks, we're long, calls on stocks, and we want those stocks to work. But in the event that they do, man, I also don't want to lose on every single position. That wouldn't be something that I want to happen.
Right.
So let's look at some other stuff. Let's look at what other names did you find today?
Well, on the UOA, I've seen a lot of tech stuff.
Yeah,
looks pretty interesting. For example, I've seen some AMD action, Microsoft, Intel, as well as Apple, and those are all kind of tied into each other, especially with Intel. So what I've seen, the stock drop almost 3%.
Everybody's getting rid of Intel, and they're doing their own chip.
They're getting rid of Intel because I think Microsoft is doing their own chip, and Apple's doing their own chip, Amazon's doing their own chip, everybody's doing their own chip, and Intel seems to be kind of,
they got to figure something out.
Right, they got to figure something out, especially with the fact that they've been, getting killed by AMD and all these things. So, in the morning when I was looking at Intel, there was actually more put buying, and at this point, it seems that there's a little bit more call buying, but it's all almost 50-50 essentially.
Yeah.
So when I was looking at,
what I think is interesting, to just stop for 1 second. I think AMD. Go click AMD.
Okay.
So remember the AMD. We spoke about AMD. Like they're buying December, or there's a lot of activity in December and January, and I'm not sure why. Right? I mean, that's the question we've been asking. So we have December options, the 95s. They were active today. You could see that the 92s on the drop. It looked like people were, getting involved here. They're relentless with this AMD, which makes me think that something is on the horizon, something positive. I'm not really sure, but in the morning you see the IV creeping up, and then as the market moves, as AMD moved up, they took it down. Go show me that again, that chart, the AMD. Click on that one that you just did. So take a look at this. So just to give you an idea, we're talking a little bit about the other side and Citadel and how people make money. When the market was going down in the morning, you could see that the implied volatility was up on the day, right? It was up on the day, and it was up pretty substantially. And then when the market started coming back, look how they dropped. I mean, they took the implied volatility down like significantly. Look at that. It's, it's coming from 60 down to 48. I mean, this is massive, massive. This is a massive move in volatility. I mean, not so much because it's December, 1 week, but they're still taking a lot of money out of these options. And, people ask, how do they make money? Right there. That's how they make money. They're basically selling options. They're selling options at high vol, and then when the market relaxes, everybody's reaching for them because that's what they do in the morning. And then by midday, the volatility is way off, and people start asking, how come my calls didn't make as much as I thought they were going to make? It's because the prices were elevated. You bought them, and then all they did was, it's literally like turning a dial. They just turned the dial. They deflate the board. And yes, your options go from $1. You paid $1 and it goes to $1.20. But you thought it was going to go from $1 to $2. And the reason it doesn't go from $1 to $2 is because you see that yellow line going down. They've deflated. They have, decreased it. Not only they have deflated, but then there's sellers coming in to try to take some profits because they bought calls. The stock's going up. Now they want to sell calls. It's the day trading mentality. And so these machines are very, very good at expecting you to come in. They raise the vol up, and then once you're in, then they turn the vol down, and nobody knows the difference. But you can visually see it now, how these things start moving.
We should take a session. And you should explain to me how those machines work and what's in the back end. And
yeah, so we plan. All right, so that's the other thing. So what we'll plan on. Let's plan on having something. We said this week maybe. So Thursday, instead of being live, we will put together something where maybe we do a 2-part. I don't know, but we'll figure something out for everyone that we could actually show you and give people a clear understanding of who they're trading against, how they make money, and why things work the way they work, so that people can have a deeper understanding of what they're buying, how they're buying it, when they should buy it, when possibly, why when a stock drops sharply, if you own calls, why that might be a good time to get out of your calls because the volatility still held up. So we'll talk about some of those nuances, and we'll do that for Thursday. Let's just keep it at that. Yep. Okay.
Let me just drop this in. If anybody's got any questions, they should definitely email me at marko@optionsgeek.com, especially regarding this topic. If you're interested, you want to know something in specific, we're going to get those. I'm going to ask Felix to kind of explain it further, and then we can be a good resource for you. But yeah, good. You want to go back to the board and see what else is up?
Yeah. So just to follow up here on the AMD, because they look like they're buying. I could see them buying here a little bit more aggressive for the weeklies, but I'm looking also at January. Do you see my board yet?
Yes.
Okay. So January, I'm looking at where they are actually trading, and in January options, you could see there's 7,000 here, there's 1,000 here, 11,000 of these.
You see how they're skipping spots, like
it looks like obviously these are all new. Looks like today these came out today, but they're going after potentially, I think, closing some of their positions. Last week we talked about AMD possibly selling calls, that these weren't real buyers, that they were actually selling calls. And they were doing that, and the reason I thought that was because the RR dollar was so high. In order for someone to buy the January 15 100 calls, the RR dollar is 109.54. So this has got to be, say 112 higher, 115 with an 80% confidence. That's a long way away. 115 with no real earnings, nothing, no announcement, no event. So maybe it's notification on their merger or something. But this is, to me, interesting. If they were buyers, I'm just not a believer that they are. I haven't been since Nigerian came out and said they were buyers and they were looking for something. I just thought to myself, I'm not sure what they're looking for. Unless they have an event, and that's the case, I can't see it. Looking at 115 in AMD over the next 2 weeks. That's a lot.
And
I
it's
mean,
a record level for the stock. It would
yeah,
be.
I mean, I could see a breakout happening, and then that pushes it, and people would get out on that breakout move. But I mean, that's a lot. If it's just based on technicals, I'm not sure I like it. I like more the event. I like to see that there's something. They're going to speak somewhere. They're going to say something. They're going to do something, whatever. So I think we're seeing a lot in the morning. We saw some buyers like here, 120. So the 120, you could see right in the morning, stock was down huge. They bought calls. It looks like these are calls, the 120 calls. They bought them probably because they were a lot cheaper. Stock was down and just thought, all right, I'm going to buy some calls. And then after it was up, then everything came off. But it looks like right in the morning, the stock jumped from 94 to 95. Call buyer looks like a call buyer. So it looks like this guy, open interest of 4,700, and then 44.50 trade at 931. It looks like 47. It looks like the open interest, that trades, and it looks like it might have been closing. So this one looks like it might have been a buy to close. So when I see that, I think why not have it be the same on the February's, the January's? It looks like these upside calls were perhaps big money selling against their long stock. 2 cents. So now let's go one other one that you said, Apple.
Apple, yes.
Yeah,
yes.
Apple always near the top. I mean, it's always trading a lot. Today it's trading a little bit more than usual. Stock is flat here. What's happening in Apple?
The fact that it's flat, it should be good, right? Because the market's down.
So relative strength wise, I would say yes. It's good. Same thing with Microsoft. Microsoft is trading well, and it's up now. It's up. Before it was flat, and the market was down. So relative strength is when Apple is outperforming the SPY, say, or the tech names. But here, I mean, I just don't look so much at this front week. It's all day trading and running around. And January 15th, a little bit more, but it's getting towards earnings here. So you might see some plays. There's a lot of spreads. I think, we mentioned that before. There's a lot of spreads that happen in Apple. People are playing around. This is a thick stock. It's hard to move Apple in general because it's the biggest stock, even though it does move. But people are sure looking for the next earnings to see what they say. We had a price of 138 right here. So people probably looking for 138 or higher, 145 on earnings. That would just be my guess. So I'm just going to, let's just say earnings are here. We'll take the February's. Let's just say 145. Let's see what happens. That's not even enough, right? I need 155. 155 to sort of be in that range. So if someone's going to buy, someone's buying these. If this is longs, then they're looking at 153, above 150. So the question is, can we get above 150? Geez, that's a lot. It's a lot. I mean, I can't tell you how much that's a lot in Apple. Not saying that it can't, because, it was 67, maybe this is price, but 60, 62, 12, it's a double here in 4 months. So obviously it can happen, but man, that's a lot. You're talking about a $40 move gets you to 157, 167. So a $30 move in Apple right now is what, 20, let's call it almost 24%. So 24% on a stock that is how much? 2 trillion? Let's just get the exact number. I'm going to guess 2.1 trillion.
2.16, wow.
2.16 trillion. Okay. So 25% move, 24% of that is how much? You're talking about adding another $500 billion to Apple. Geez, that's a lot.
That's huge.
$500 billion. That means that's a lot. That's just a lot in any sense of the word. I mean, companies, remember a year and a half ago, a company could be worth $500 billion. That was a lot. Now they're going to make $500 billion in 2-3 weeks. I mean, call it 6 weeks. Like, something is not jiving. It's just a sign of the times. But I think that's how, maybe people buy here. I can tell you, a lot more people play games where they're buying call spreads or 1x2 call spreads, which we could start going over some of that as well, and looking at this, let's say March, let's just say February here. February, you get the earnings and you have a dividend. So we look at, if you're long Apple, at least somebody's long Apple, and maybe they saying, all right, I'm thinking about getting out of Apple. I would buy it a little bit lower if it got back, lower. So maybe I could, sell let's just say I'm just throwing this out there. Sell the 115 puts at say 3.25, just to have a number. And then I can buy, because I still believe in it, I can buy the 135, we'll call it the 130, 150 call spread. So I can buy the 130, 150 call spread for about 475, call it 470, and I can sell the 115 puts at 3.25. So that's $1 so let's just say it's $1.50. Okay, so I pay $1.50. I could pay $1.50 and I get exposure between 130 and 150, and I buy my stock back at 115. 115 less, plus 150, so 116.5. Right. So that's how, these thick names and stocks that you can actually trade around. People do these types of trades where they are, managing the risk reward over earnings. So 115 is 10 points lower, 6%. It's not even that much, but maybe you do something where, and I can tell you, see this right here, 3-month sentiment bull bear. This is skew. So this is telling me that the calls are, on a seesaw, the calls are better bid than what they usually are against the puts. So the sentiment here is bullish, meaning that people are reaching for upside calls. So in that scenario, you can actually do something where you do like a 1x2, where you would buy 130 to sell 2 of the 150s, buy 130 call, sell 2 of these 150s at 2. So that's 2 times 2 is 4, plus minus 675 minus 4 is 275. And then you sell the 110 puts at 2.25. So that's 275 and 2.25 less 2.25 is 50 cents. So, these are the type of structures sometimes people do if they say to themselves, I want to be long Apple, but 126, maybe I can get, if it goes down, I'll be happy to buy more, like 110. So then they do this type of strategy and they only pay 50 cents, and then they can get exposure from 130 to 150. Now with the 1x2, if it goes to 170 or above, then you're getting short the stock, which you don't want. So it's a little bit more of a finesse game. You got to be a little bit of a surgeon here, but if it goes to 170, we're talking about another $1 trillion in Apple in the next 6 weeks. I don't know, could happen, but that's what people bet against.
Right.
Okay, so that's Apple. I see people all the time. They're using a lot more spreads, and because it's a thicker name, Apple shouldn't move up, shouldn't move $40 higher. It shouldn't move $40 lower either. But in this market, I can't say that that's not possible. Right. So let's look at another one. Let's look at actually one that's interests me was this FireEye.
Right.
Did you see this today?
Yes, I did. Big move.
So the FireEye here, let's look at it. FireEye, just to read it, because you have to get comfortable reading this. 20 up $1, almost up 5%. Earnings are not till February. A lot of options trading, and mainly in the call side. It's trading already 5 times volume, and the implied vol is up 11 handles. So clearly, this is being bought. Okay, this is these options on this board in FireEye are being bought here. The question is, what are they buying? Are they covering? Are they not covering? Because it's 5 times the relative volume, I suspect there's a lot of new positions. I think I had it here. All right, let me close that. So FireEye, we have the January 15. I mean, we talked about this one last week. It was 13, 14 bucks on the hack. Right. It was down. Probably not good for a security company, but it was trading really well prior to that. So the thinking was, at some point, can this thing just shoot back up? obviously nobody knew that they were going to get more information and the thing was going to be, okay, explosive for the whole industry. But here we are. The stock is now from 14 to 20 and people are buying, big calls. I saw these today, the January 21 calls, right out of the gate. You could see implied volatility going up, stock going up, implied volatility going up, and these are calls. So you also see 10,000 and 3,700. It looks about like 15,000 options are being bought here. So 15,000 options is how many shares? 1.5 million shares. So when people buy, someone's buying 15,000 options, and you're talking about a $21 call with the stock trading 18. It's probably only, let's see here. I can do it by doing this. 21 to 30. Now it's up, but it was probably only a 25 delta option, which means 1.5 million shares times 25% is how much? Almost 400, 375,000 shares to buy. So when someone is buying, people look at this and they say, why does the implied volatility sort of track? A lot of times track the stock. It attracts it because people are buying calls. So they're buying options forces this IV up. So these are calls, 21 calls. The IV is going up when the volume is hitting, which is telling you that there's a buyer. Okay, that's how you read this. Now, it tells you it's a buyer. So now you say, okay, there's a buyer of calls. How many? 1.5 million calls, right? 15,000, 1.5 million shares worth. Okay, so on a 25-30 delta, that's how many shares to buy. So now the market has to buy, or the person who sold these calls has to go out and buy 375,000 shares of stock. So that's why you're starting to see the stock rip higher. Okay. There's also share buying. There's also people buying the stock, but people are buying the market makers, Citadel or Virtu, whoever's selling these calls, Goldman, whoever, they are actually buying the stock. They're in the market as well, buying the stock. Then they buy it. Hangs out. There are buys here, comes off a little bit and stays. So this is somewhat bullish. It looks bullish. It looks like a real buyer, and then there's real. It didn't go down, so there's still buyers at this level. So that's how I would read this. This looks interesting, but man, to have missed it at 13 and then it goes to 21 and now you're going to buy it. This person's thinking to buy the 21 calls at $1.50 for January 15th. He's thinking closer to 25 and a quarter, 26, right? 26, yep. Right? So there we go. So now, see, you're getting better at knowing how to sort of find that target stock price. So here's the target stock price. You can look. We might just have to go monthly because I don't, So this was a high flying stock back in the day. Okay, we're talking about 2014, 15, and then been trading like this forever. You're talking about breaking this level. You're talking about 4 years. 1, 2, 3, 4, 5 years. Okay, 5 years of work between $20 and $10. 10 to wow. That's a long wait. People have been waiting for this for a long time. Maybe a takeout, maybe something. There's always rumors in this thing for a long time. And now getting to a point where look at the volume here. 200 million shares, 200 million shares at these levels. And, people have been messing around between 10 and 20 for 5 years. So there's new buyers here. Or maybe they're short covering here. I don't know, yet to be seen, but somebody's reaching for the 21 calls. If it breaks out here, 10 to 20 is $10. A breakout with real volume could be 20 to 30 here. I think that's what someone's sort of looking at. Like if this is a real breakout tomorrow, you could see another $2, $3, and then it gets stupid because people just either covering or whatever. That's how generally these things work. So I'm not sure it happens in the next 3 days, but this is a good development for FireEye and all the other names. One ETF to look at would also be Hack. Right? Hack. So this one's interesting. I have it on the radar. If this is truly a breakout on the FEYE on Friday, I'm there. One other name that I saw that's interesting, that's active today is, let's bring this back down, Ford. So you see a large trade in Ford happening.
I want to ask you the put side as well.
Yeah, so it's the put side. So someone's and they're still going. So this is a massive
wow.
trade. So I saw this early, and it looked like someone was getting out of their. They actually have the sevens.
Yep.
They're getting out of the sevens. I had it written down, so the market's already moved, away from where it was to show it. But they have the sevens, and they're getting into the March 8s. It looks like there's open interest here, so they're selling the February 7 puts to buy the March 8 puts. There was 90 something thousand of the sevens. So they're doing this, looks like 90,000 times. And you can see that what's interesting is not all of it comes up as spreads, but they might not be doing it all together. Oh, here it is, all spreads.
Right.
So they are doing it as spreads, but it looks like they are, they're selling the sevens in February and they're buying the eights in March. Why? Your guess is good as mine. We'd have to look at, they have an EV section. They've put out the Mustang Mach-E,
Right.
they have momentum here. People like the stock. They were buying calls. Things have slowed down. I don't think this is the end of the story for Ford. Maybe it just takes a break. Usually stocks don't end like this, right? They usually end like this for a while, and then it goes here and then trades a lot further down. This is sort of, maybe a holding pattern. So this is interesting. I don't know why. Someone might be just long a lot of stock and just hedging a little bit here because it had such a big move. But I'd have to look further into this. But this looks interesting to me that someone is buying puts here. Let's see what they're thinking, right? On the March puts, they'd have to be thinking 6.5, right? Let's see, 6.5. Again, this is how you would think about it. 6.5. No, let's try 6. So it looks like somewhere between 6.5, 6 and 6.5 is what they're thinking about. And again, this is how you use the unusual. Nobody's teaching you how to do this. This is specifically that I'm trying to show you that because I built a machine that thinks one way, and now we're getting the actual trade, you can go backwards and sort of figure out what the person was thinking. So the person's got to be thinking around 6 to make it a good risk reward trade. Can it get to 6? There's a lot of volume right around here. There's a lot going on here. 6, I don't know. To me, that would be a disaster.
Yeah,
that would be a disaster. So I'm not sure. Could be somebody that's just long 10 million shares, and it's like, what? Let's just, it's either going to go to 12 or it's going to go back. It's not going to work, and whatever, they're going to stop like an EV or whatever the answer is, and it comes back down. But it could be someone who's buying that as protection, although it's a lot. I have to say that's you talk about how much are they spending for that trade. They're spending 41 cents, so they're paying 3, 4, 5% on that notional. Yeah, about 4 or 5%. That's a lot. You own a stock and you're going to give away 5% on some insurance. It's not. I wouldn't call it like something. I wouldn't say that's something everybody is loving to do. So I'd have to look to see this earnings, how important this earnings is for them. I know their story a little bit. I like GM. When I was looking at GM, I liked it a little bit better. But Ford has got something. They're a big company. They're shifting over to EV like everybody else. How does that shift work? Can they be successful? Even GM has problems with that shift, and maybe they sort of. Actually, here it is. Ford poised to soar 30% higher. No, the surprisingly good reason why Tesla should acquire Ford.
Yeah, I was reading that one. It was interesting.
Yeah, interesting. I read it too. It's interesting commentary. So that's something that I would look at. But again, this
goes against this narrative that we're looking at right now.
Yeah, it goes against there was a lot of coal buyers, people excited about the EV, but maybe that has died a little bit, or maybe that, something else is causing this thing, or maybe coronavirus, and people are concerned that, in the event that coronavirus, people aren't buying cars or doing anything, and it's another year where sales are down, and they have obviously a lot of manufacturing plants and costs and pension fund, to return to meet liabilities. This could be a disaster if coronavirus goes on longer than what is, what everybody thought it would be done really by spring. We'd be back to normal by summer. What if that's not the case? These companies still have to survive. They still have to, still need business. So I don't know, something to think about, but that one was a big trade looking at. And I would say there's this Mara too, which we spoke about.
It was really interesting. Yes. Because we spoke about Riot and then Mara.
Yeah, we spoke about where's Riot. Riot, I mean, this thing can get some legs, but
yeah,
here's call. See, people here's look at the summer 20. This is weeklies. There's 50,000 options traded into weeklies. I mean, people realize that the theta in the weekly. If you're going to hold an option that's 177 volatility and it doesn't move $2 on Monday, you see that you don't really make that much money. People get tired and they start selling out of all these day trading, type of positions that they had. Mara is not going to be any different, except Mara has moved a lot. It's up 18% today. Big call buying here. You're talking about 200 volatility. You see how they're not buying the Marches, or in the Marches here, it looks like they're buying something a little bit different than it's smaller options. I don't know if they're getting out of it or some way higher ones, but you look at the 11 options in Mara, for March, it's $4.
Right.
For almost 40% of the company is in options. It's very, very hard. It's almost like you should just buy the stock. Right. That's why I always say, be careful with these. Anything under 10, just be careful. But even 11, you just got to be a little careful, because if at this level, you can buy the stock at a 50% margin, which is $6, and then you have the stock for much longer than March if you want.
So for those, let's call them cheaper stocks, does it make sense to play a faster game? Because if you look at January's, they're probably not $4.
Yeah, I mean, you could, but again, you got to be really right. You get one tomorrow, if this thing's down $1.50, I tell you that you're going to get killed on some of these things. So if you're trying to risk manage these things, it's very, very, very difficult. It's very, very difficult, because you can easily get stopped and then it goes up 1,000%, and it'll drive you mad. So what you do to prevent that, if you are going to do that and try to play it, you try not to have as big a position as normal. Normally we're in positions where it's, call it 30 to 50, 60 volatility. Generally, this is 3 times that. So instead of having, X dollars in, a normal position, you might want to have 1/3 of the dollars in something that's this crazy if you're just going to play around. Right. So I don't mind. I say people, if you have an idea, you want to play around, it's not a problem, but just understand that the higher this number is, the less dollar amount you want to play, because the volatility is so high, and you can be stopped. You can have your stops a little bit wider, because it's likely to get stopped. 200 volatility is basically a good back of the envelope calculation. You just divide this number by 16. So that's close to 12. So that would be 12%. So the market is saying every day Mara is going to move about 12%. Right. That's what the market's pricing in, about a 12% move a day. So imagine one day when it doesn't move, it moves like 3%. Forget it. That that's the decay. So whatever you see this number, you could just divide by 16 to get an idea of what it's sort of saying it's going to move today, from the highs to the lows, the range. So for example, it might be a 40 vol name. 40 vol divided by 16 is what? 2.5. So that's 2.5%. It's much different than 12%.
Right.
So that's just a simple way to think about it and say, okay, the market's pricing in this type of move per day. Per day, right. Every day until March. You're talking about March, there's a lot of days. So every day this stock will move, is being priced. This stock will move approximately 12% a day.
Wow.
Can that happen? And by the way, that includes the weekends, which it doesn't happen. So on just trading days, it has to be a lot more.
Right.
So maybe it's 14% if you just include trading days, 40, 50. That's a lot. So that's what I'm saying. When you put it in that perspective, it's like, can we make money like that? That's hard. It's hard. It's much harder than you would think. Playing around in these big names is good when it's good, but when it turns, you can get the double whammy with the volatility being so high that you paid and the wrong direction. And there you go. You have a double whammy where you get beat both ways.
Right.
So I think this one's, the Mara is interesting just because they're playing it. You can see what they're looking at. You're talking about in Mara, let's just look at March, because that's a little bit meatier. The 10s to 2,700 of these, they're being bought. So you'd got to be somewhere around 25, 26, 27.
Wow.
So you're talking about $29, $30 to buy that. That's a lot. That's a lot.
Yeah.
In this high vol, it's, because what is it? What is it basically? I mean, look, it's close to at the money. So you would basically say you can go with the large. Okay, so with the large volatility names, sometimes this thing, because this is based off the Black-Scholes formula. Sometimes it may not be as high, but when you get to 200, because you're talking about $11 stock with $11 of with $4 of calls. But when a stock is moving on a high percentage, and you do the math, let's do the math. So if a stock is moving at 100% volatility, what's the expectancy of where the stock will go? It's zero. The stock is going to go towards down. It's going to go zero, because if it moves up 100% one day, it goes from 100 to 200. If it moves down 100% the next day, it goes from 200 to zero. So the higher these, it's sort of like the Black-Scholes starts, to some extent breaking down because of these super high vols, because you're bounded by zero, and so it starts pushing out. The model has to start. It's log normal models, meaning a stock can only go to zero, but it could go to infinity. So it starts pushing out the possibilities to the outside.
Right.
But you have to pay for it. So they're forcing you to pay for that opportunity.
Cool.
All right, my man. What else? Anything else?
What else did you see here on the UOA? I've seen.
Trying to look to see. Here's one. I saw a American Airlines, and I just thought that was interesting because obviously the Congress announcement last night was had an airline had information about the airlines, and I think that these stocks, these options, some of these things deflated. Well, in the morning they were deflated, but now it looks like they've picked up again. But if you look here, this sentiment, again, this is calls are better bid than puts. When it's bullish, calls are better bid than puts. Implied volatility is not as high anymore. It's low. So I'm looking at the February options and trying to figure out what happened in February, because there's 81,000, and I see a lot of put trading here. It looks like because of skew being low, it looks like, which means that the puts are lower relative to the calls. It looks to me like this was a sale buy. It looks like someone is actually rolling up their puts to the 16 puts. Okay, until February. And that's what I see there to me. And I look at that because I was looking at this trade and trying to understand what someone is doing. There's 17,000 open interest there. The volatility was going down when these traded. Okay, volatility was going down. And ultimately, as they were trading the stock, found a bid. So it looks like maybe they were selling these, right? And then these 15s, same thing. When the stock was here, this is at 1040. 1040 is right around here. So the volatility looks like it's a little bit lower than where it was. 77.5 was yesterday, so it looks like 76. So it's probably a sale. So it looks like this was a sale. This was a sale. It looks like a spread where they're just getting out and rolling into something like this.
Mm-hmm.
Right. So 16, thinking 12.5, is the $15 billion for the airlines enough to keep them afloat? You get another coronavirus surge with this new whatever you call it. The UK is announcing that they're having problems with this new type of COVID-19. Then this thing was trading 11 during coronavirus days, trading 9. The reason it's trading 9 is because airlines go bankrupt, and historically airlines have trouble if there's not people flying. If people aren't going places, they have trouble. So the world has changed. Business class is probably not as booked as much as With everybody Zooming, business meetings are being held online. You don't have to fly everywhere now, and that's changed. The amount of people flying has changed. So, the potential for disaster in the industry is still there, hasn't changed. There's positiveness from 11 to 18 and a half because of the vaccine, but that doesn't mean it's over. We're not either clear yet, and is 15 billion enough for an industry that probably needs a lot more than that? I don't know. So that's probably somebody's saying, I'd like to have some puts just in case. Could be long the market, but just in case coronavirus is bad, they're looking for these sort of bets that they can get paid off 3, 4 to 1 in the event that, all right, I'm going to be long the market. Now let's just find, Marriott puts, Hilton puts, AAL, RCL, just in case. Just in case.
I see. Right.
All right. Any questions? Anything else?
I'll save some for tomorrow.
Save some for tomorrow. All right. Awesome. Marco, always a pleasure. We'll talk later.
Felix, talk later.
All right. Be good.